All right, so we've looked at the three tools of monetary policy. We have the reserve requirement, the discount rate, and open market operations. Now, all of these serve to influence the money supply. The reserve ratio does so by changing how much banks have to hold on to. The discount rate does so by affecting the cost of borrowing money to cover the reserve ratio. Now, notice that as the Fed chooses to increase the discount rate, or in a sense, if they use open market operations to influence the federal funds rate, it's going to influence the cost of borrowing money to cover the required reserves. With a higher cost of borrowing money, banks are going to be more sensitive to loaning out too much, meaning that they won't want to do it. So here we can think of banks as responding to the federal funds rate, or the discount rate, as with a higher interest rate, they'll tend to loan out less, meaning that an increase in the interest rate is going to decrease the money supply. Again, we looked at the open market operations, which is the buying and selling of government bonds. We can see that the Fed has the ability to increase or decrease excess reserves that a bank holds onto, meaning that they can increase or decrease the interest rate via the money supply. So that's the missing link right now. How is the money supply and the interest rate connected? Well, here we're going to use the money market. We have some quantity of dollars, and here we have the nominal interest rate. So in this case, we're looking at how much money do people want to actually hold on to. Well, here we're going to have some demand for money. Our demand for money is downward sloping, meaning that at lower interest rates, people tend to hold on to more money. Why would you do this? Well, say there's a 20% interest rate, meaning that if you were to keep your money in, say, government bonds, you could earn 20% per year. That'd be a very high interest rate. You might be likely to say, hey, I'm holding on to this extra cash. I could be earning 20%. I'm going to put it in the bank. If instead you can earn somewhere down here, say 0.5%, you don't have very much incentive to keep your money tied up in things like a savings account or government bonds. So here you'll tend to hold on to more money, things like cash or keeping your money in a checking account through demand deposits. You'll tend to hold on to more at a lower nominal interest rate. The money supply, that is the amount of money that's out there, is independent of this. So here we have the supply of money. We also might label this MS for the money supply. So here we see that we have our money supply, our money demand, and we end up at some interest rate. Now say that the Fed engages in some kind of expansionary policy. That means they're going to try to increase the money supply. By increasing the money supply, they're going to decrease the interest rate. Now, why would they do that? At a lower interest rate, what's going to be affected? Well, we might think that at a lower interest rate, people are going to be more likely to invest and consume. If you're considering buying a new house or a new car, that being investment and consumption, respectively, at lower interest rates, you'll tend to buy something that's more expensive or just be more likely to buy in the first place. So let's think about how this all maps out. Say the Fed chooses to decrease the reserve ratio. Then banks have more excess reserves, meaning that our money supply can increase. With an increase in the money supply, our interest rate is going to decrease. With a lower interest rate, consumption and investment will tend to increase, leading to an increase in aggregate demand. So here, it's a little bit convoluted, but if you understand each step, then it should all make sense. By decreasing the reserve ratio, banks have more money on hand that they can lend out. If they choose to lend that out, the money supply is going to increase. With a larger money supply, that is, there's just more money out there, you'll tend to get a lower interest rate. With lower interest rates, it's going to be less expensive to buy things, both for consumption and investment. that's going to lead to an increase in aggregate demand. So, say we look back at our aggregate demand, aggregate supply graph. Well, if we're looking at that graph, what situation might we be in that we want to then increase aggregate demand? Here we have our real GDP. Here we have inflation. Here we have aggregate demand, long-run aggregate supply, and short-run aggregate supply. Say we're down here, we're willing to take on a little bit more inflation in order to decrease unemployment. So in this case, the Fed would use expansionary policy. We could solve it the same way using fiscal policy. That would be an expansionary fiscal policy, trying to shift aggregate demand to the right, or increase it. Now instead, perhaps we're facing too much inflation, say at this aggregate demand curve. Here we would want to decrease aggregate demand because our inflation rate is too high. Now here, this would be our long-run inflation rate. Now looking at what we think will be happening in the short run, that is short-run equilibrium, we would be at this point, where this is our level of inflation, and this is our level of production. So here, we're producing more than the sustainable amount, meaning that we're incurring too great of inflation. So what we should do here is decrease aggregate supply, or aggregate demand. We can do that through fiscal policy. That would mean increasing taxes or decreasing government spending, or we could do it through monetary policy. Through monetary policy, we could increase the reserve ratio, increase the discount rate, or choose to sell bonds. Now, with the buying and selling of bonds, I sometimes get confused, so I like to check myself really quickly. Say we sell bonds. If we sell, that means get money from the banks, meaning that banks loan less, so our money supply has decreased, meaning that the interest rate is going to increase, meaning that consumption and investment will decrease. All right, so that makes sense. So here it must be that if we choose to sell bonds, we're going to decrease our aggregate demand. All right, so we've looked at monetary and fiscal policy. We see that they can influence our aggregate demand curve. Fiscal policy does so through government taxation and government spending. Monetary policy does so through the reserve ratio, the discount rate, and open market operations. Those influence the money supply, which then influences the interest rate, which influences consumption and investment, which then influences our aggregate demand curve.